Have you heard the Fed say, look, we can't relax on rates because inflation can come back very, very quickly. If we start to go, oh yeah, that's it, we're done. Okay. Boom, we're right back into the inflation shit. We're right back into, well, we kind of cooled our jets. And then all of a sudden, the Fed spread starts to get back above 100 and we're right back into crisis. This is actually a really good example of that. A month or two ago, everybody went, okay, everything's fine. But you notice orange line. No, it's not fine. Actually, we're starting to M out and we could very easily go right back into free fall here. Do we have the first week of the quarter in the books? Yes. Do we have the first 2 weeks of the quarter in the books? Yes. I think we can start getting a pretty good idea of what the fund managers think is going to happen this quarter. It is interesting that this quarter, wow, that's kind of weird. Look who's outperforming. That's the utilities and healthcare. Well, utilities and healthcare, that would be over here. So we went from here over to here. Does the market maybe not have a fucking clue what the hell's going on? I don't know. Was there any incentive for market participants to bid up healthcare or utilities that might have skewed the data? I don't know. Maybe I'll pose that as a question to the community. I don't know what the answer to this is, but it is interesting how HalfEd has clearly demonstrated through his study. The first week, healthcare utilities outperforming. Communication services was like, no, no, and I get the feeling that they were like, no, this is, the economy's still hot. The economy's, where I guess the part of the cycle, right? The economy's full recession, market bottom. No, this is it. And we're going to be here and we're going to fucking rock and roll and everything's going to oh, wait a minute. No, maybe we are still here. And it's interesting because we're kind of, where the hell is the damn inflation problem? Because remember, the one major problem with this whole thesis last quarter, and maybe there was some fundamental driver in this part of the market that was causing the distortion there. I don't know. But the one missing component about this entire thesis was interest rates falling. And we know, based on what the data is saying here from the market, that interest rates are not falling. In fact, interest rates are still rising, right? When this goes down, it means interest rates on the short end are going up. So this was the problem with this whole thesis was, wait a minute, there's something not right here. And then the yield curve, well, the yield curve is still inverted. It's not normal right now because interest rates are not cranking down. I think that the banksters and maybe the market to a certain degree was kind of hoping that the SVB event was the catalyst that broke the economy and we would go into free fall. And as a result, the Fed could actually calm down about raising interest rates and you would see this orange line spike up because they believe that the economy has officially rolled over and this banking crisis was going to bring an end to the economic expansion. And as a result, the Fed had to get more friendly. Nope, wrong. Not even close to right. Is the Fed now going to have to continue raising rates? According to the orange line, I think so. I don't know whether they have to do it aggressively. Notice the slope of the curve here, right? This is like uber aggressive. This is a little bit more shallow of a slope. Is that the right term to use? I don't know. Maybe we start, they go to like quarter point raises, right? And they just calm things down a little bit. The one good part about this is that the Fed spread is still relatively okay. We're down here at 0.36, so we're nowhere near crisis. At the same time, too, notice spread's starting to try and bottom out here, right? If we start going up through this 0.4, then that will be a big W. You can see orange line. They are basically making new lows here, even to today. So the Fed can't take its eye off the ball. And if the orange line starts cranking up and the Fed is not raising rates, then that means we might go back into crisis. It is interesting to sort of conjecture, and this is another question I'd have for the community. Somebody give me some feedback on this, if you could, please. What specifically happened in October, November 2022? I think it was the election, and I think it was the Republican Republicans taking control of the House of Representatives were sort of bringing a halt to the runaway socialism that was just rampant there, which was all about this, is that, the market saw the runaway socialism and fucking Biden and all the Democrats, MMT, all that. I mean, they're just stupid economics. And the market was like, holy fuck, this is going to be insanely inflationary. And sure enough, the spread went absolutely crazy because the Fed didn't really want to raise rates. So Fed begrudgingly says, okay, fine, we'll raise rates, which means, of course, we're going to have to pay more, which is going to hurt the economy on the long run anyway. Of course, it's going to cost everybody a lot more money. Way to go, socialist. You really fucked up again. Thanks, substitute drama teachers. Love you. Hugs and kisses. I think that the Republican elected House of Representatives kind of put the kibosh on the runaway socialism. And of course, the Fed needing to raise rates and get in front of the curve, they brought this ratio back down to sort of like, okay, at least this is manageable situation. But you can see Mr. Orange's, if anything, we almost got the indication. And I think maybe this was why the FinViz and all this were sort of pointing. Remember last quarter, we had all of this part of the market dramatically outperforming because I think that they thought that we were here, and they thought that we were here because look at the orange guys. The orange guys were like, all right, they broke the market, fucking A. We don't have anything to worry about. We finally turned the corner. And you can even see the Feds themselves were like, okay, we can calm down a little bit. Nope, back into the shit you go. And if anything, this is a really good lesson to all of you. Have you heard the Fed say, look, we can't relax on rates because inflation can come back very, very quickly. If we start to go, oh yeah, that's it, we're done, okay, boom, we're right back into the inflation shit. And we're right back into, we kind of cooled our jets. And then all of a sudden, the Fed spread starts to get back above 100 and we're right back into crisis. Have you, I don't know whether you pay attention, but I've heard the central bankers say that repeatedly. This is actually a really good example of that, where a month or two ago, everybody went, okay, everything's fine. But you notice orange line. No, it's not fine. Actually, we're starting to M out and we could very easily go right back into free fall here. So I don't think the Fed has the luxury to say, that's it, we're done raising interest rates. In fact, actually, I think there have to be more interest rate increases coming down the pike. And that's this kind of conversation. Manufacturing is not slowing down. Manufacturing is actually putting in a W and getting ready to ramp up. Why? The housing industry is still going gangbusters. Thank you, Mr. Fink. And the interesting thing is it's not consumers who are buying up the houses, it's these goddamn fucking mutual funds. It's not even like it's real economics. It's bizarre what's happening. Oh, we live in bizarro land, that's for damn sure. But what I wanted to show you was, remember we had said yesterday, you'll know that this market is broken when the mortgage market, the housing interest rates, they've topped out. No sign of a top there yet. We will know that the inflation problem is dealt with when this TIP versus TLT spread. This is what I teach you people in the level 1 course. This is what you pay money for. You tell me. I don't know, Meg, what letter of the alphabet do you see happening here? What does this look like right here? That does not look like an M. What letter does that look like? Inflation is perking back up. And heaven forbid this damn spread gets back above here. Then you're going to have this big honking W. Ah, Jesus H. Christ. The Fed does not have any permission whatsoever to stop raising interest rates. So can you see how the Canadian economy could be just in absolute disastrous shape if the Fed just keeps having to raise interest rates more and more and more? And then that brings us full circle. Why is this TD Bank the most shorted bank stock in the world? Because Canada's economics are completely fucked. I teach you guys that this is where the cycle should have ended, 2017, 2018. And you can see how the market started to correct. The market was underway. The whole correction process was happening. And then all of a sudden we got this fucking stupidity of this goddamn fucking sickness insanity injected into our worlds. And everything got turned on its head. But that doesn't mean that this cycle should stop. If anything, This has made the cycle even worse. That in itself was the warning that, oh boy, shit's about to hit the fan. It should make sense to all of you, given all of the rants that I just went through, why TD Bank or Canada and Canadian proxies are a really, really good short here. Because it's just stupidity what's going on in the world, thanks to this whole sickness fucking idiocy that we've been put through.